Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. Donald Trump warns Iran that there are stronger sanctions coming later today, sending crude prices higher. The GST Council extends the tenure of National Anti-Profiteering Authority by another 2 years, also clears a proposal to introduce e-invoicing in phases. IndusInd Bank promoters will infuse 2,700 crore rupees into the private lender through a warrants issue in order to raise the promoter holding back to 15% after the merger with Bharat Financial. And IndiaMart's 475 crore IPO opens for subscription today. Promoters will offload their stake via an offer for sale. Well, let's take a look at the trade setup for the day. It looks like we'll have a start which is flattish in the green. But I think the world last week was a tale of a few charts. One, across the board we had seen rallies. So it rarely happens that, asset classes across the board would show a rally. But this is what happened. S&P 500 went up about 2.2%. Crude went up almost 10%. Gold went up 4.3%. On an average, the rallies were about 4.5%. And this is keeping in mind that the bond markets also had a fairly decent outing across the world. I mean, there are various studies now that are coming up which are showing about how bonds have been one of the best asset classes in the recent times. But look at that. Yields, Japan, US, Europe, India, everywhere. Yields have come off and therefore bonds too have largely been rallying. So it's been quite spectacular really to be in almost any asset class last week and you would have largely made money. Indian bonds too, I think they've just, the yields have just cooled off quite rapidly. You could see those intermittent bounces, but by and large the trajectory has been lower for the Indian bond markets as well. And of course, Donald Trump's tweet about how the thing between Iran and the US, I think it came out late Saturday or early Sunday morning, when he's saying that Iran cannot have everything. I mean, I'm not quoting him verbatim. Verbatim is Iran cannot have nuclear weapons. Under the terrible Obama plan, they would have been on their way to nuclear in a number of years. But he will do something different, and therefore, all of this has led to crude prices moving up as well. Remember, today is a big day, as our headline stated. There might be some additional sanctions on Iran and therefore increases those geopolitical tension in Western Asia for sure. And lastly, just one small update amongst everything else that has happened. The People's Daily, which is the government's mouthpiece in China, has said that China will fight the trade war till the end. We are waiting to G20 outcome this week, but ahead of that, the People's Daily having said this also means something important. So lots that's happened across the world and might have a bearing on what happens to asset classes as well this week. But what happened to our markets? Well, 2 or 3 interesting things that one needs to monitor. One, remember, it's expiry week, the monthly expiry week, so it'll be important the volumes naturally be higher. And if we look at what the indices are poised at, we're poised at very interesting levels. So the Nifty or the Nifty Bank, for example, in or around those levels from where it could bounce back. It's taking support at this 50-day moving average, or trying to take support at this 50-day moving average. And also in technical parlance, it's at a 50% retracement level from the highs as well. So all of that should be interesting for the Nifty Bank as well as the Nifty. 11,600 for the Nifty will provide some key support. As I said, some key retracement levels that everybody is watching out for. And volumes did show a glimpse of an uptick in Friday's session. They were substantially higher, even though FI buying has largely been missing. DIs have bought heavily last week, either to the tune of 2,500 or 2,600 crores. But FI buying has largely been amidst lower volumes generally, save for Friday, which was a high volume day. But very difficult to preempt what the markets will do. The SGX Nifty indicating a start, which points towards a flattish opening, 11,764, but hardly any movement there if the SGX Nifty is to be believed. However, there are stocks that could react, and there are 4 or 5 that I thought were important, therefore bringing them to you. Firstly, IndusInd Bank, the PTI report suggests that promoters will raise stake, infuse about 2,700 crores via warrants. The prices, various prices have come out in the open or been in the dealing room checks, etc. Maybe higher, maybe it provides a bit of support to IndusInd Bank. Let's wait and watch what this stock does in the session today. Max Life could be in focus. Radiant Life has completed purchase of 49.7% stake in Max Healthcare from Life Healthcare. Let's see if Max India has some reactions in the session today. Fitch has downgraded Jain Irrigation. Remember, after a pop that happened on Thursday, some bit of gain on Friday's session as well for Jain Irrigation. but this downgrade, let's see what it does to Jain Irrigation. As also, of course, there's another downgrade that has come in, but I'll come to that. Firstly, some negative news. Glenmark, U.S. FDA has issued a complete response letter. They've cited deficiencies in the drug master file for Ryaltris. The deficiencies pertain to API and manufacturing facilities. May not be too serious, but Glenmark Pharma had already reacted on very high volumes in Friday's session. Let's see what it does in the session today. Speaking of downgrades, as I said, India Ratings has downgraded Reliance Infrastructure. The long and short-term ratings have been downgraded to default. Let's see if this one reacts in the session today. And Dr. Reddy's has gotten a Form 483 with 2 observations from the US FDA as well. So 2 pharma companies, 2 downgrades, and a couple of companies on which there are some positive news from the financial space, including IndusInd Bank and Max. So a few stocks that could react in the session today. However, let's tell you what's lined up on First Word today. Is a collection of the top editorial stories that we want to bring to you. The rupee will be the big monitorable, but besides that, Tata Consultancy Services and Reliance Industries in a neck-to-neck race in market capitalization. Darshan Mehta will tell us where they stand. ITC shares are only half as expensive as its biggest competition. Agam Vakil will analyze if the valuations are justified. Vedanta guides for a weak performance in the current financial year. Nikki Mirchandani will tell us what's got the metal giant worried. And cricket may be the best thing RNFS has invested in. Sajid Mangat will tell us all about that bet that is paying off. TCS and Reliance Industries have been in a cat and mouse game for the past few months, trying to outdo each other in the market capitalization game. TCS took the lead just this month. Darshan Mehta is here with an analysis of just how much steam may be left in both the counters, considering they are 2 of the biggest heavyweights on the Indian bourses. Darshan, good morning.
Good morning. And we've seen, Neeraj, that both of them, the market caps pretty much have actually been at par with each other. A few months ago, it was Reliance, which was much ahead. But of late, Reliance has been underperforming, and TCS has actually gained market share. So pretty much it's a race to who becomes and who stays the largest listed entity in India, and a race pretty much now becomes the 10 lakh crore market cap. There's still time, but if you see the top 10 companies in India in terms of market cap, these 2 seem to be pulling away. It's their own game. So TCS and Reliance. The next bet is HDFC Bank, which has been a constant 3, while the others are pretty much lower. So it's a race that it's a 2-horse race at this point of time, and both of them have actually pulled away from the rest. Now, if you take a look at so what we try to do is find out who has the edge now, what are the factors indicating, and who will come out much stronger. So if you see what has happened on a year-to-date basis, if you're looking at it, TCS has managed to outperform, and even on a month-to-date basis, it's TCS which has managed to outperform Infosys. This month itself has been bad for Reliance, which is down almost 3%. Now, if you look at the weightages, Reliance has a much larger weightage on the Nifty, 9.5% compared to TCS's 4.8%. For the Nifty to now move, Reliance needs to perform. So the contribution this month itself, Reliance has contributed to a 43-point downtick, while TCS has continued to move up on, and that is helping the Nifty, stem off some of the losses that Reliance is putting up on the index. Now, if you're looking at what the analysts are saying, they certainly have more faith on Reliance at this point of time, because 61% of the analysts have a buy recommendation on Reliance with an 8% sell. The number is much higher on the sell side for TCS. And even if you take a look at the Bloomberg consensus estimate, the percentage upside as per Bloomberg consensus estimate is a 12% upside on Reliance and a 4% downside on TCS. So all the factors currently are pointing out that the street is anticipating a better run from Reliance. Now, in terms of most bullish calls that are coming in on both the counters, so we are looking at a race on who will go in higher, or probably who will reach the 10 lakh crore market cap first. So if you take a look at the trend, Edelweiss, Nomura, Goldman Sachs, all of them have indicated these are the top 3 in terms of target prices. So they still anticipate anywhere an upside of 20 to 30% on Reliance, while the best of targets still indicate just a 7% upside on TCS. So the street is still much more bullish on Reliance at this point of time. The other factors that we're looking at is valuation. Reliance on a valuation basis is pretty much trading on near the FY21 valuation. So it's slightly higher. The FY21 number is at par with the 10-year average. For TCS, it's still expensive. It's still expensive 22 times on an FY21 basis compared to the 10-year average. So valuation-wise, Reliance offers much more valuation support than TCS at this point of time. The other factors is let's take a look at the companies individually. What are the concerns and what what are the positive triggers for them. For concern for Reliance is that the refining and the petchem margin is not working. The core business is weak. There is significant amount of over dependence on performance of the retail business and performance of the consumer business as well as Jio. There is lack of pricing power in the telecom business, and debt seems to be a concern for them. What probably will work for Reliance is the clarity on the InvIT structure for the telecom infra. Fundraising, if any, for the telecom and retail arm. A lot of notes have come about it. Growth for Jio in the retail business is something that you need to watch out for. And capex is over in the business. So the core business, oil and gas, even though it's not doing well, it's a cash generating business. So if that starts firing and Reliance Retail and Jio start firing, Reliance could see potential upsides that would come in. Now, what probably are the concerns and what could work in for TCS? Valuations are rich. So a lot of reports that I read indicated that there is no room for disappointment because valuations are already rich and trading at a premium. Tight labor market and U.S. norms. You see Donald Trump tweeting everything every day. So that could be one of the potential. If he tweets something negative on the H-1B norms, or that could mean negative for some of the IT companies. And there are growth concerns in BFSI and retail because they are already growing at much faster pace. So whether this run rate will continue or no, that is something that we need to watch out for. What are the triggers? The management in the recent interactions have indicated that there will be double-digit growth in the medium term. It has a well-diversified portfolio with a strong presence, and digital seems to be the new trend as far as some of the IT companies are concerned. They have pushed significantly in the digital space and are expecting significant amount of growth. So on a like-to-like comparison, what the valuations are, what are the analyst trends indicating, what the Bloomberg consensus is indicating, at this point of time, it seems that Reliance seems to be in a better spot, but as of now, TCS is performing better.
Well, let's wait and watch what happens in the medium term. Thanks so much for that, Darshan. Keep in mind a couple of things that you need to monitor when you're looking at these companies. TCS bogged down maybe by the overall IT slowdown. Reliance bogged down by the debt levels that it has. It'll be interesting to see what breaks out sooner rather than later. Recent released GDP growth data and high-frequency indicators, including volume growth for automakers and FMCG companies, point to a slowdown in consumption. We've been talking about that for a long time now. But valuations of consumer staple makers continue to be rich, barring one player, ITC. So how cheap is ITC? And are the valuations justified? Agam Akhil is standing by with those answers. Agam, it's a million-dollar question. Like people grapple with this, ITCs always remain cheap.
Yeah.
Is it cheap enough for people to buy? Are the valuations justified? What do you have for us?
Yeah. No, there's no doubt about the fact that ITC is cheap. Of course, we all know that the reason is because of cigarette business. But we must also remember that the cigarette business no longer contributes to, well, more than half the revenues to ITC. So, of course, things have changed after FY19. And let's take a look at how ITC's valuations stack up right now. So, this is where ITC is. As you can see, for FY19, which you see in the yellow, and for FY20 estimates, which you see in blue. In both cases, it is the lowest among the top, I would say, 8 companies with a market capitalization of more than 30,000 crores. And I'm only talking about, FMCG companies. As you can see, while ITC has gained to a certain extent, it is nowhere close to, many of its other peers. And let's not forget that ITC now has an active contribution from non-cigarette segment, which makes it a very interesting question as to whether or not you can expect ITC to catch up with, some of the other players, if not trading at levels of the other peers, at least higher than these valuations. And that brings me to the point of growth prospects as well as earnings. As you can see, again, ITC, it's comparable as compared to the other guys, considering the likes of Godrej Consumer, Colgate, and Marico earnings have been, or rather revenue growth has been volatile. ITC has been fairly consistent, and based on that, of course, it is certainly comparable to a lot of the other players. If you leave out something like a Marico or perhaps something like a Dabur or a Nestle, it is very much in line with a whole host of other FMCG companies. Let's come and talk about your EPS growth too. Again, while EPS growth can be compared, can be compared to something like an HUL, possibly not Godrej Consumers because we have seen that decline, but it's still better off and it's still hanging on. It still has consistency and stability in terms of earnings, which would lead us to the question as to what and how it stacks up against your analyst ratings when it comes to the other FMCG companies. So, as you can see, ITC is the highest rated on the analyst rating on Bloomberg consensus. It has a score of 4.5 out of 5, and it's actually higher than HUL, which is very interesting. In fact, not only is it highest rated in comparison to some of the other peers, but it also has the most return potential from current market levels of around 26%. As you can see, while a lot of these other companies do have an upside, but none of them have as high a return potential as 26%, and none of the ratings are as high as ITC, which it has scored about 4.5 out of 5. So for now, based on the various parameters of growth in terms of revenues and earnings, as well as valuations, ITC is the most preferred bet in the FMCG pack.
So, I mean, what is the broad brush comment of the analysts, and what are the pulls and pressures on the company?
Right, fair enough. So let's talk about where analysts stand as far as ITC is concerned. Now, this is your analyst rating on the Bloomberg consensus. We have about 40 odd analysts on the consensus. About 34 of them have a buy rating on that counter. About that comes to around 87% of who are the analysts who have a buy. And based on that, we have, as I was suggesting, a return potential of 26%. Let's talk about the pros and cons for holding ITC. So I'm going to start with the positives. The first and perhaps the biggest positive is that the fact that it's become consistently profitable when it comes to its non-cigarettes business, especially the FMCG excluding cigarettes business. And not only has it been consistently profitable, the profits are improving. They're getting higher. And of course, this is also to a certain extent a result of the kind of capital expenditure that they have carried out, and the investments they have carried out in ITC. And as a result, we've also starting to see personal care segment, see a little bit of an improvement. Of course, brands like Fiamma and Vivel have starting to do well for ITC too. It's starting to see a lot of improvement and appearance on the shelves. There's marked recovery in hotels. We all know about a relatively good year that ITC has had, especially with the kind of volatility that we've seen in the previous few years. And of course, in terms of your paperboard business, which moves largely in tandem with the FMCG space, there's been higher realizations, and hence paperboard and packaging has done well. But there are, however, a few cons, and of course, the biggest con in this case is the cigarettes business, the kind of risks that the cigarette business faces, and of course the illegal cigarette market, which actually has grown over the 5 years as compared to the legal cigarette market, which has actually seen a contraction. And of course, this is always going to be a problem, something that the authorities have not been able to contain, and that may very well work against the country's largest tobacco maker, at least as far as the official tax net is concerned. Punitive taxation, again, of course, this is something that has always worked against ITC. And in terms of some of your other, variables, we do have volatility in the agri-business. Again, a lot of that depends on the monsoons. So these are also some cons that may work against ITC. But if you take the larger picture, if you take everything into consideration, there is no doubt about the fact that ITC may very well have some more upside, at least based on the Bloomberg consensus.
Well, let's wait and watch. Thanks a lot for that, Agam. It typically tends to have these upsides. Whether or not the stock reacts is another story altogether. Well, moving on, the ongoing trade war has one of the world's largest miners worried. Vedanta, which came out with its annual report, has guided for a weak performance from its zinc and aluminum divisions for the current financial. Nikki Michandan is here to tell us how the company sees FY20 panning out for all of its verticals. Nikki, good morning.
Good morning, Neeraj. Actually, the theme which is expected to play out for 2020 as per the annual report is the cost control measures that we're seeing in aluminium and zinc division, and the kind of expansion that an oil and gas division could witness. Clearly, they're painting some amount of optimism coming in for their oil and gas division. But let's start with the zinc division first, which contributes to around good 40%, more than 40% of its operational performance for FY19. There we expect some sort of cost of production coming down for the company. They're expecting actually 1,000 per ton kind of cost of production as compared to 1,008 that we've seen for FY19, which is a tad higher as compared to FY18. In terms of the debottlenecking, and along with that, the smelter capacity is expected to lead to the lower cost of production on account of some amount of increase in volume that we could witness in Zinc India division. If you look at the prices that we're expecting, it has been a 10 to 11% kind of downtick coming in for the zinc division as a whole. But then they expect now the prices to go down further with the ongoing trade concerns, even as the fundamentals of zinc division remain to be pretty much strong, even globally for that matter. Aluminum division, that's another high contributing division for Vedanta as a whole. If you look at the FY19 performance, there itself we are expecting cost of production to come down by as much as 8 to 10 odd % for FY20. If you can see, that's a mix here. The bar here are both of LME prices as well as the cost of production, which is expected to decline. If you look at the number, the blue bar is the hot metal production, which the cost for FY19 was around that $1,940 per ton. That is expected to come down to around that $1,700 to $1,775 per ton kind in FY20. That's a good 8 to 10% kind of reduction. And if you look at the pricing scenario, they're not expecting any kind of uptick there. In fact, they're expecting the prices to remain range bound. However, the lower cost of production comes on account of two things. That is the increased sourcing to bauxite, which is a byproduct or rather a key raw material to alumina, and reduced imports on alumina, which typically is expected to go down well in terms of cost of production. But net, if you look at the outlook, prices are not expected to inch higher. The case is different in terms of oil and gas division. If you look at the production scenario, so far they've been missing the targets for oil and gas division. Going forward, they're expecting a 200 to 220 kind of KOPD kind of production coming in for FY20. That's a count of increased production that they're expecting from one of their basins, which will help them achieve this kind of guidance, which is a little positive coming in from the larger scheme of events for company, because this oil and gas division contributes to a good 30 to 33% kind of, the operational performance for FY19. But Neeraj?
Yeah, what about the financials, Nikki? And are they expected to improve this year?
Actually, financials, if you look at the growth picture, we aren't expecting much out of the company. If you look at the debt to equity EBITDA ratio, that's the operating leverage, that's actually increased to 1.1 times. That's probably the highest that we've seen since FY16. And if you look at the interest coverage ratio, the yellow bar out here, that has declined for the company. 11.4 times goes to 7.8 times, which is a clear reduction in terms of the company's ability to go ahead and provide it. But let's not forget the fact that we're talking about Vedanta, which is a cash-rich company, and the situation at the current level also seem to be pretty much decent. But then if you look at the EPS for this company, that's also at some years low. 18.5, this is the lowest probably that we've seen since FY16 for that matter. And going forward, the growth capex for the company, which is at 5-year high level, is a positive. But then this, along with the high payouts, potential payouts, could lead to cash leakages for Vedanta. Just a point that I'd like to make, if you look at the start of the year, the analyst recommendation, it was 100% buy rating on the counter. That has now reduced to 47%. So clearly you can see the shift of analyst rating or their preference in the metal counter for that matter.
Okay, Nikki. Thanks so much for putting that into perspective. Some analysis of the Vedanta annual report and some key comments on what the prospects could be for the year ahead. Well, a cricket club, maybe one of the best investments RLFS Financial Services made over the past few years. The bankrupt company, which is currently in the eye of a storm, holds a sizable stake in Chennai Super Kings, shows MCA filings. Sajid Mangat's here to take us through the details. And Sajid, how much does this hold? What's the value of that stake?
Okay, so to go back, Chennai Super Kings was suspended for 2 seasons, 2016 and 2017, and they came back in 2018. And in 2018, they won the finals against Mumbai Indians, and 2019
they lost the finals.
They lost the finals to Mumbai Indians. So Mumbai Indians and Chennai Super Kings are arch rivals in that sense. So when they came back, this all dates back to 2015 when India Cements decided to transfer the division into a wholly owned subsidiary, and the shares of the subsidiary to be distributed to all the non-promoter shareholders. So what India Cements did was to transfer entire shareholding in the Chennai Super Kings Cricket Limited, which is a subsidiary which owns the IPL franchisee, to a trust, and subsequently after all permissions came in, especially from BCCI for distribution of shares, the shares were distributed as early as this year to all the shareholders there. In the run-up to 2018, Chennai Super Kings needed money, working capital, and other for other purposes. So it raised 65 crores from IL&FS Financial Services. This was in form of 8% optionally convertible debentures, convertible into 2020 at a conversion price of 9 rupees 12 paisa. That's a conversion price which is there. Now, on a wholly diluted basis, it would have given IL&FS nearly 18 to 19% in the company, which means it would have been the second largest shareholder in Chennai Super Kings going forward. The valuation is mind-boggling, because when the shares started coming into the market, because entire shares were distributed to over 1 lakh shareholders, that's a very big group of shareholders. The shares start coming into the market, and we've seen in the OTC market or the private market a lot of deals being done on Chennai Super Kings shares. The stock has risen from 16 rupees or at the beginning of the year to OTC market to nearly 32 to 35 rupees per share. Now remember, this is just a 10 paisa face value share and not a 10 rupee face value share. So there's a hectic trading happening in this. There's a good demand for it. To give a perspective of what kind of revenues it could have, because last 2 years there was no revenues from BCCI. The year prior to it went into suspension, the revenues were around 175 crores and the profit was roughly around 17 crores for Chennai Super Kings. So that's the kind of financials we are looking at for Chennai Super Kings as we go forward. And perhaps people are also looking at that valuation. Based on that, they are looking at the valuation. A Duff and Phelps report spoke about a valuation of $98 million in 2018. That would have gone up substantially in 2019 as well. But the point is that at 35 rupees on a fully diluted basis, it's coming to roughly 1300 crores of valuation for Chennai Super Kings, which is good amount, because if it goes for listing, it will be at a much higher valuation going forward. And for IL&FS, this investment, which came at 65 crores, would have gone up to roughly around 200 to 250 to 270 crores odd. So that's a good investment for them. Ironically, IL&FS did not respond to our queries, nor India Cements, nor CSK. In fact, people in IL&FS doesn't know that they even made this investments. So that's a big thing which is happening here. But for the company to list, there are a couple of things which needs to be done. I don't know whether the company will list, because none of the shareholders who got the shares have got any communication from CSK till now. Okay. Hopefully this will be the first AGM where the shareholders will meet and there will be some kind of communication that comes in. They will have to first seek an exemption from SEBI from going for an IPO. Because these are shareholders of an existing company, so they can list, but that needs an exemption from SEBI. Second, they will have to consolidate their face value to 1 rupee at least, or 10 rupees, whatever it is. That means that a 35 rupee share become 350 rupee share, or 3,500 rupee share, based on if 1 rupee or 10 rupees is the face value consolidation which comes in. So all these processes needs to happen, and listing is something which now the shareholders are going to do, because you have nearly 22% FIs invested in this company, nearly 7-8% mutual funds is there. IL&FS is around 20 to 18, 19%.
Even though they don't know about it, but that's okay.
But I'm sure Uday Kotak is a smart man, and he will ensure that it goes for listing so that he has an exit.
Well, it'll be interesting. And about time that we have something like that listed in India, because it's happening across the world. Yeah. Sajid, thanks so much for putting that into perspective. Well, IL&FS made a good investment. Just before we wrap up, first of all, I'll tell you who else has made a good investment. If you're invested in either of these two asset classes in the recent past, you would have been laughing your way to the bank. Bitcoin is northwards of 11,000. That's quite a telling jump in the price of the cryptocurrency. I mean, it's all the talks of it probably being banned in multiple countries. There's talk of that happening in India as well. But the cryptocurrency keeps on rising. It's gone parabolic. That's an apt line, really, for the rise in Bitcoin. People seem to have forgotten the fall or the catastrophic fall that had happened from the highs of $19,000 odd dollars all the way to 3,000. So if you were invested here, you would have made money. If you were invested in gold, you would have made money, because the precious metal is really on an upsurge across, not just in India, but across the world as well. And the rise has been quite stupendous. So, yeah, well, Chennai Super Kings, one investment, not too many we can make. But the cryptocurrency or gold, well, if you had made those investments, you would have been laughing your way to the bank for sure. That's all that we have on First Word today. Lots more lined up on Indian Open though. We will discuss markets, macros, and what to do in the near term with Saurabh Mukherjee of Marcellus Investment Managers. And then as liquidity in surplus according to RBI, but do housing finance companies need more cash? We speak to Gagan Banga of Indiabulls Housing Finance about the same. And after this break, a full tilt towards the day's trade. Stay tuned to Bloomberg Quint Live.